Hi, welcome to the Real Estate Roundtable, where we discuss all topics real estate. I'm Nick Ahrens.
Hey, and I'm Steve Crowley.
I'm Darren Shepard.
And I'm Jimmy Reed, and we're your hosts.
All right, everyone. Hey, welcome to our first podcast for the Reed team here at RE/MAX Coastal Homes. And the reason for these podcasts is we get so many questions from clients and even other agents a lot of times on what's going on with the market and the news that hits, and sometimes it's coming from the actual news, the internet, your wife's book club. I mean, it could be coming from anywhere. And so we thought we'd put together these podcasts just to give people a chance to kind of hear what experts in the field are actually saying, especially local to our market here in South Orange County and Orange County area, but also just in general throughout the country too, because it affects everybody. And we have people moving in from all over the place and even moving out. So, it's kind of nice to have that information. So today we're going to be talking about the foreclosure moratorium that came off and how that's impacting the market, or how we anticipate it to impact the market. And with that, we've invited Amit Singh from the Neo Home Loans Group or the Insight team at Neo Home Loans. And we invited Amit because he has got a lot of great experience in the mortgage industry and with as a lender. So welcome, Amit.
Thank you so much, Steve. It's great to be here. Yeah, my name is Amit Singh. I'm a team leader here at the Insight team. I've been a lender for about 8.5 years now. And so definitely been doing this quite some time, seen a lot of, maybe not the craziest ups and downs of the markets, but definitely have seen some trends in the past 8.5 years or so. And so I'm excited to share with you what we have here for you guys today. A lot of information surrounding kind of what the moratorium is going to mean, what it's going to mean for the outlook of the market here in the near future, in the longer term future, and how it kind of compares to the last recession that we may have had, or that we did have, and what that's potentially going to look like for new homeowners that are looking to get into the market, and homeowners that have been in the market for the last couple of years as well. So really excited to share some info with you guys.
Fantastic. Well, with that, maybe just tell everybody what a foreclosure or forbearance moratorium actually is. Kind of a couple of big words there.
Yeah, absolutely. So, back when the pandemic, was just starting, obviously, there was a tremendous amount of people that were, being put out of work in a very, quick period of time. And ultimately, the federal government decided to step in and say that, hey, with so many people, being out of a job, they decided to allow people the opportunity to put their mortgages in what is called forbearance. And effectively, that means that there was a halt that they, that consumers and the homeowners were able to make on their mortgage payments for a period of time. That period of time started out as 3 months and then continued to get extended out to about 1.5 years. And so that time frame, basically, all homeowners that were impacted by COVID had the opportunity to ultimately put a halt on their mortgage payments, so they didn't have to make mortgage payments for that fixed period of time. And now that moratorium for people to not have to make that payment has effectively ended. And so it's definitely going to be changing some things in the market. So I'm really excited to kind of go over what we have here for you. But yes, that is effectively what the mortgage forbearance has been. And, it's allowed a lot of people to not be able to make their mortgage payments during this period of time while they were affected. And so it's helped out a tremendous amount of people. It's also, limited the amount of people that have had to sell their homes to, financially make ends meet during this period of time, which has also afforded them an opportunity to continue to see the value and appreciation in the market over the last couple of years as well.
So it's been a good thing then for those that were, maybe lost their jobs or had a setback on their jobs. I know that I've heard people, say, oh my gosh, so these people are just not paying. So what's going to happen when the moratorium comes off? And they all of a sudden are being hit? Are they going to have to all of a sudden come up with this lump sum payment that, what's going to happen?
Yeah, it's really not going to be, like anything large that, the homeowner is going to have to deal with. It's not, nobody's going to have to make these large lump sum payments of all of the missed payments that they effectively had. Nobody had their credit impacted because these were federal mandates that homeowners were able to utilize. So it did not actually impact their credit scores. Now, what it effectively did is it took the lump sum of the amount that they missed in effective mortgage payments over the course of the last year and a half, or however long they were in forbearance, and effectively they tacked that lump sum on to the back end of the loan. So if someone's just coming out of mortgage forbearance, it's as if they just didn't have to make mortgage payments for the last year and a half, and now they just start making their mortgage payments as normal. But now there is going to be a large chunk of whatever that amount was that they had not made in payments over the course of the last year and a half is going to be added to the back end of the loan. And so it was great in the sense that, hopefully some of the people that, were impacted by the pandemic during the last year and a half, hopefully they'd been able to, if they were on unemployment, this obviously helped them not have to make large expenditures, which the majority of people's largest expenditure is their mortgage payment. It allowed them to hopefully save a little bit more cash. So that way, once that moratorium ended, they have a little bit more cash on hand, and they, have the ability to now continue to start to make their mortgage payments until hopefully they do get employed if they're not employed again already. The good thing is because it didn't impact your credit score, it is going to be limiting some people from being able to refinance right away. But the good thing is they have allowed a lot more leniency in terms of the refinance opportunities for people that were in forbearance. Basically, as long as you have made your most recent 3 mortgage payments in the last, basically 3 months. So effectively when the moratorium ended, people have the ability to now refinance and take advantage of, interest rates if they had not been able to since the pandemic began. Because obviously we saw some of the most historically low interest rates that we've ever seen happen, in the midst of the pandemic. While so many people were able to take advantage of those rates, the people that were in forbearance, unfortunately, were not able to unless they had made their last 3 months of consecutive mortgage payments. So hopefully if people are, able to make those payments now, then they'll have an opportunity to at least, take advantage of, not as historically low as they once were, but still fairly historically low interest rates today that are available.
Very good. So most likely the people that have been in the forbearance, it's been about 1.5 years, I think, right? Isn't that about right for when that whole thing started?
Absolutely.
So prior to that, we were looking at probably interest rates still in the low 3s, right?
Absolutely.
So most of these people are not stuck with a 5% interest rate or, something that high typically. Is that correct?
Yeah. So pretty much anybody that had, if they were, depending on when they refinanced, if they were able to refinance right before the pandemic, they probably have a mid to high 3% rate.
Okay.
If they hadn't refinanced since, let's say if they bought their home in like 2018 or 19 and they hadn't refinanced, they very well could have, mid 4 to high 4, maybe even low 5% interest rate. And so for a lot of people that are coming out of that moratorium, if they haven't made payments over the course of the last year and a half, they probably weren't thinking too much about refinancing because they were probably more occupied by, the pandemic going on and then, potentially being significantly impacted by that. And so a lot of those people may still have those higher interest rates. Now, the good thing is, like I said, if they have the ability now to make 3 consecutive on-time payments on their mortgage and their credit ideally hasn't been too impacted because the missed mortgage payments never negatively impacted their score, then they would have the opportunity now to at least get themselves, out of the higher monthly payment that they were in and ideally into a lower monthly payment. Now, the one caveat to that is that, because they haven't, if someone hasn't made payments over the course of the last year and a half, probably going to have a much higher payoff when they ultimately go to refinance. So their loan amount would probably be a little bit higher. But that coupled with the fact that they're going to be reducing the interest rate still should end up giving them a better mortgage opportunity. And there are going to be lots of loan modification opportunities that are most likely going to be coming to fruition here in the near future as well. There's going to be people or lenders that are going to be out there that are going to allow people to modify their loans potentially into 40-year loans. So that way they can stretch that payment out a little bit longer, lower that actual principal and interest payment a little bit more, and give people some more relief to be able to hold on to their homes and not have to list it on the open market.
Oh, very good. I was just actually thinking the other day, I thought, let's say somebody had a $4,000 a month payment, mortgage payment, and this hit and they went on the forbearance program So let's say they went a year and a half, so they didn't make $60,000 or about $70,000 worth of payments, let's say, something like that, in a year and a half. And I started thinking about that. I thought, well, and that's tacked on the back end of their mortgage now, but the equity that they gained in that year and a half is insane. I mean,
Yes.
on that $4,000 a month payment, what would their principal? How much did they probably pay for that home? I mean, figure 20% down or something like that. So, what were if at say 3.5%, like 800,000, something like that, probably on a home like that. Is that about right? You think?
Are you
Somewhere
talking
there?
for like a
$4,000 a month? Yeah.
Yeah, that would probably be putting them between
Something like that, yeah.
$800,000 home.
Well, that
And
$800,000 house, I guarantee you, is worth now close to $1 million.
if not more. Yeah. So they've built a tremendous amount of equity. So for the majority of people, any amount that they put, on the back end of their loan because they, put their mortgage in forbearance would have far been exceeded by the amount of equity that they would have built. And, just based on the appreciation the market has seen over the course of the last, almost 2 years now. And so, that's why we're really not anticipating a tremendous amount of people just walking away from that equity if they can't make those mortgage payments. So there's been a lot of kind of chatter about there's going to be a lot of people foreclosing on their homes now, and just so that way people understand, right? When you're foreclosing on a home, generally, if you look historically, right, the people that were foreclosing on their homes were people that didn't really have, a tremendous amount of equity, or they were underwater on their homes, right? And so they weren't really walking away from anything. If you go back, to the 2007, 2008 mortgage crash, that was a product of just bad lending practices, right? Anybody could walk into a bank with nothing but a smile and a pulse and get whatever type of loan that they wanted. And, ultimately that, in hindsight, obviously that should have, been something that could have been foreseen, but, I wasn't in the industry back then, so I my hands are clean there. But ultimately, there was a lot of bad loans that were, being placed, out in the marketplace. And so when those loans, had balloon payments or adjustable payments that had come to fruition, ultimately those people could not make those mortgage payments. And so they started foreclosing on those homes because it also bought at kind of the top of the market. But ultimately, the reason that they were foreclosing is because they couldn't really afford those loans, right? They couldn't afford those monthly payments, and they never should have been in those loans to begin with. Now, when you look at kind of the crash, not the crash, but when you look at the crash in comparison to what we're seeing right now, right now, everybody that's gotten a home loan in the last 12 years has had to qualify for that mortgage now. And so and when we've seen historically low interest rates, which has also pushed, home values up quite a bit. But anyone that's bought a home in the last 12 years effectively, or even in the last 2 years, right, has a significant amount of equity in their homes. And in a foreclosure process, if the foreclosure would effectively be the last step that you would want to take, right? If you can't make your mortgage payments work, if you have a tremendous amount of debt that that's overwhelming you, but you have a home, you can effectively sell that home and get the cash out of that home, right? Sure. And right now there's a massive inventory shortage across the nation, and so people are clamoring over others to try to get into homes right now. There's still a tremendous amount of buying activity trying to happen. There's just not enough inventory to support that buying activity, and so anybody that can't make their mortgage payments could literally just turn their home, onto the open market, sell their home, cash out their equity, pay off their loan, and they wouldn't have to worry about foreclosing, right? Maybe they miss a couple of mortgage payments here and there, but the foreclosure process takes quite a bit of time, and a lender has to offer you, opportunities to be able to either modify that loan or, structure some kind of repayment form with that lender directly. And so there's a lot that would have to happen for someone to get to the foreclosure process. And if that person listed their home on the market today, we're going to see that home sell ideally within 2 weeks. And so, we're not going to really see the foreclosures really happening because nobody's going to want to walk away from all of that equity, right? If they foreclose on the home, if they had 10% equity sitting in the property, they would forego that. Why would anybody forego that right now? And, as long as they have someone who's smart that's advising them, then ultimately that's going to be, someone who can at least help them get out of their homes, get out of the situation that they're in, and maybe go back to, renting for a short period of time if they absolutely had to.
Sure. Absolutely. Yeah. That's, I get people ask every once in a while, they're like, well, do you guys come across any foreclosures and stuff, like investors and things? And I'm like, no, in fact, actually, I think the last stat I saw was Orange County had less than 2% foreclosures that were even listed. out of the 1,800 that they have, which if you do the math on that, it's like less than 3, out of 1,800. So it doesn't, there's just isn't anything out there. And those are, usually big issue homes and stuff like that. So yeah, it's just non-existent. And here we are, in November, and the moratorium ended when?
July 31st.
Yeah. So, and we're just seeing less and less. I think the Motley Fool just came out yesterday morning with an article on the whole foreclosure thing. In fact, it was titled "Foreclosures Are Down Despite Moratoriums and Pandemic Concerns." And then the subtitle was "Experts Were Predicting a Flood of Foreclosures After the Expiration of Moratoriums." But the data shows that far from the case. And they even showed they had a thing at the end there. It said that the total number of loans in forbearance as of October 24th across the nation was a little over 2%.
Yep.
So 2.15%. That's what the article said.
And so I think that's like something like, about 1.5 million people that have been across the entire nation. And when you look at kind of the data of the number of people that are still in forbearance or that still were in forbearance in comparison to the amount of people that actually foreclosed on their homes back in 2007, 2008, there was over 10 million homes that were foreclosed upon back, during that time. And we only have less than 2 million people that are even in forbearance, all of whom have built a substantial amount of equity in their properties over the course of the last 2 years. And so, unless you bought your home literally 2 weeks ago, you're going to be probably in a good enough place to be able to get out of the, after, fees for selling a home, you should be able to still walk away from some cash.
Yeah. As of this morning, I think we had, in Orange County, we had 1,850 homes on the market. And usually at this time we have, this time between 2017 and 2019, those 3 years there. So you're not counting the pandemic. I think the homes on the market at this time of the year was 6,200.
Yeah.
So I know we got 1,800. So we're talking about 3 times less homes. We had 3 times more homes on the market back then, and we're still selling homes like crazy because people are capitalizing on the low interest.
Yep.
And we're not expecting to go up really much in this even next year. Much over 3.5%. I think Fannie Mae was saying, right?
Yeah, so the average rate next year is expected to be around 3.5%. We're still slightly under that right now. Now, when you look historically, that is still a historically very low interest rate, right? And so, in the short term, we may not see the crazy, appreciation that we've seen over the course of the last 2 years. I read an article, that was put out by Goldman Sachs. Goldman Sachs is still anticipating, because of the lack of inventory in 2022, another 16% in appreciation that year. And so, there's wild statistics that are being thrown out, here and there, but, if it comes from Goldman Sachs, I would imagine that it might be fairly trustworthy, but, the fact that there's just not going to be enough homes that are listed for sale to meet the current demand of the consumer is ultimately going to be, one of the biggest factors as to whether or not the housing market is going to stall or, pull back. And right now, we're not seeing anything on the horizon, seeing that that's going to slow down anytime soon.
Yeah, we're still getting multiple offers simply because it's a supply and demand situation. And as long as homes are affordable, so there's one of 2 things have to happen. Either interest rates have to rise to catch up. So if I remember right, 2008 interest rates are not 2000, it was 2013, I think it was, where interest rates started coming back up. And then 2018, they came up. And 2018, I remember that clearly because it began the year in the 3.5%, 4%, and it ran right up to 5% by the end of the year. And that's when we saw a slowing of pricing a slowing of pricing, and also a rise again of inventory.
Yep.
Because buyers started pulling, backing out of the market, and that's just what happens. But then the interest rates started coming back down. The pandemic hit. They dropped the interest rates, and we're right back where we started with. Now we're selling more homes than we can get on the market, and and it's interest rates just really do control the market. They're the biggest controller of the market.
Yeah, it's the cost of borrowing, right? So
Exactly.
if the cost of borrowing continues to rise, then that's going to limit how high home prices can go, because ultimately affordability is going to be tougher and tougher. But yeah, I mean, you're absolutely right. But even in 2018, right, when we saw that jump up in interest rates, we definitely started to see the market kind of slow down, but we didn't. We still had a positive appreciation year.
Yeah, it never dropped.
The market's never dropped. Now, that's not to say that the market can never drop, whatsoever, but there has to be a massive, like, for example, if you look historically over the course of the last 50 years, we haven't seen, many massive drops in home values, right? The only time that we saw that was back in 2007, 2008. And that is understandable, right? Because there was something that actually happened, which was, a tremendous amount of bad lending practices, a lack of lending guidelines that, lenders had to follow. And so ultimately people were put into these loans that they couldn't truly afford. And so, like I said previously, right, everyone that's bought a home in the last 13 years has had to effectively qualify through much more stringent, lending, standards. They've had to qualify with lower debt to income ratio requirements, reserve requirements for jumbo financing. And ultimately all of those people that qualified, their mortgage payments most likely have dropped over the course of the last 10, 11 years, because they would have refinanced again and again. They would have tapped into some equity, built more, appreciation in their home by, adding more to it, upgrading things and whatnot. And so, everyone that's in a home right now is in a really comfortable position in terms of the amount of equity that they've built. And so, previously people were buying at the absolute, top end of their range with loans that they couldn't, afford. And so ultimately they had to give up those homes because, home values were declining because there were just a bunch of bad lending practices that were going on. So we're not anticipating that type of a foreclosure, market to happen again. And so even if we do see a little bit of a stalling in the market with interest rates going up, one, I don't expect it to happen until after 2024, because the Fed has basically, stipulated that they're going to keep interest rates artificially low through that time. They're not going to be adjusting the federal funds rate. And so long term, we may see, some value fluctuations, but if you look historically, those value fluctuations are going to be, anywhere from 3 to max 10%. We're not going to be seeing the 30-40% drops that we saw back in 2007, 2008, because that was a completely different scenario back then.
Absolutely. Yeah. Well, very good. Well, this has been very enlightening, and I hope our audience will enjoy it. And then we also would encourage people to give us some feedback. Let us know what you think. If you got any other questions, if you got some topics that you would like us to cover, this is for you. So anyway, thanks, Amit. I really appreciate it, and looking forward to the our next podcast.
Hey, thanks again for listening to the Real Estate Roundtable. If you'd like to connect with any of the sales partners here on the REIT team, our information is below, and we'd love to chat with you.